Welcome to Dukascopy TV with me, Alex Isat. Today we will be taking a look at how the UK is faring as it walks the path to recovery. The Bank of England's quarterly inflation report is scheduled for later today, and joining us to give an insight into what we can expect is economist for CEBR, Danae Kyriakopoulou. Danae, Mark Carney has said that the UK has edged closer to the point at which the bank rate will need gradually to rise. What does this mean for the inflation rate?
Well, the statement has to be taken in context. We have seen a very volatile set of signals from the Bank of England in recent months. While the bank's latest inflation report sent a relatively dovish message in May, in the months that followed, the members of the Monetary Policy Committee have started to move in a different direction. And as you said, both Mark Carney and the MPC's new member, Minouche Shafik, have at times stated that spare capacity may have fallen faster than expected and that the time of a rate rise is edging nearer. But there have also been dovish instances. For example, Carney's speech at the Treasury Select Committee in June and the latest MPC minutes. So this instability in attitude from the Bank of England has added to a confusion of the bank's forward guidance policy, which dictates that spare capacity levels will have to fall sharply before a rate rise is considered. At CEBR, we expect this moment to come in early 2015, but it depends on how quickly the recovery spreads to the labour market. Unemployment has fallen down sharply this year, but underemployment and productivity remain important concerns. Now, in terms of the outlook for inflation, our forecasts see consumer price inflation starting to pick up in the remainder of the year, building up to the interest rate hike in early 2015. But even so, inflation is expected to remain modest, close to the bank's central target of 2%. This is because of a relatively benign global inflationary outlook, which has kept inflation in the UK contained. And we don't think this will change in the near future. Main driver of this has been the slowdown that we've seen in emerging markets, mainly China. This has kept food and energy prices low. And the other driver is a weak economic environment and disinflationary forces that we've seen in the Eurozone. It is unlikely that either of these will change anytime soon, but there are some risks. For example, geopolitical tensions in Iraq and Ukraine could push up energy costs more than expected and lead to a spike in UK inflation.
What should we expect in the Bank of England's inflation report?
We expect to start seeing signs of a hawkish descent among the committee members as the likely time for an interest rate rise is drawing near. As I said earlier, CEBR expects this to take place around the turn of this year. We will also be expecting to see comments on how the bank assessed the effectiveness of the measures of the Financial Policy Committee that were taken at the June Financial Stability Report. These new recommendations included asking banks to test whether a 3% rise in interest rates over the first 5 years of a mortgage would affect an applicant's ability to back their loans, and also a limit in the number of mortgage loans which are offered at income multiples of 4.5 or more. While mortgage approvals have been following a downward trend recently, the effect has not been dramatic so far. The latest data from June even showed that mortgage approvals have actually started to rise again. And house price growth continues to be strong. According to the nationwide measure, house prices are still rising at double-digit pace across the UK. But on the other hand, it's not a surprise that the bank's efforts to cool the housing markets have not been that effective. After all, banks were already stress testing the impact of a 3% rate rise on prospective borrowers, even before that was recommended by the bank. And the 4.5 income multiple frame that I mentioned was an issue only for a small minority of new mortgages. Finally, the most important thing perhaps from the inflation report will be the bank's updated economic forecast. We'll be paying most attention at the bank's estimate of spare capacity in the UK economy. In the May report, this was estimated to be around 1 to 1.5% of GDP. But since then, the labour market has shown some signs of tightening. But on the other hand, the rate of underemployment remains high, and businesses surveyed for the ICAW's Business Confidence Monitor are still reporting that they're operating below capacity. This indicates that there is still some slack in the economy. So it will be interesting to see if the bank has changed its view on this.
Do you think that the UK is finally on the path to recovery?
The UK economy has shown plenty of very encouraging signs this year, and GDP growth has been very strong in the data that we've seen so far for the first 2 quarters of the year. Forward-looking indicators such as the CEBR and YouGov Consumer Confidence Index and the ICAW Grant Thornton Business Confidence Monitor suggest that a strong momentum is likely to continue for the rest of 2014, but growth is expected to be slightly slower in the second half of the year. Overall, CEBR expects the UK economy to grow by 3% over 2014, and this will make it the fastest growing economy in the G7. These are all clear signs that the UK is on a path to recovery, yes. But there is still some way to go. Even though the size of the economy was reported to have recovered to pre-crisis levels in the last quarter, GDP per capita still remains well below its 2007 level, and wage growth has been very slow. In fact, real wage growth has been negative throughout most of the year. To the extent that this continues, it could have a negative effect on consumer confidence and in turn consumption levels, which directly impact the rate of economic growth. Last year and so far this year, rising house prices have supported strong consumer confidence, and this has offset the weak household financial situation from low wages. But as the housing market starts to cool, the weak earnings factor could prove more important, and this is a risk. And beyond 2014, there are also challenges. These lie with the government's managing of its own pocket. The country's public finances are not in the best condition, and even with rising growth and associated growing tax receipts, the deficit remains high. This means that heavy cuts in government spending will be an unavoidable task for the next parliament, and as a result, we expect growth to slow to 2.4% in 2015 and 1.9% in 2016. And only at this point do we see GDP per capita returning to pre-crisis levels. So it's a long way to a proper recovery.
Thank you for your time, Danae. Keep watching Digiscopy TV for more news on the UK economy and the market as a whole. Until then, goodbye.